In this video, we're going to be talking about Coca-Cola stock, ticker symbol KO. So we're going to be doing a little bit of a stock analysis, take a look at some of the financials, take a look at some of the dividend history because this is a dividend paying stock, and then we're going to take a brief look at the valuation today and how it compares to in the past, and look at my position in my portfolio. Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and if you are new here, most of my videos are focused on dividend investing, and that's what this portfolio analysis series is all about, is taking a look at all the companies in my dividend portfolio and just doing a brief analysis of them. So that's what this is, and if you don't want to miss out on any of these future portfolio analysis series, make sure to subscribe to the channel and like this video, because that really helps other people see it and helps just the channel out as a whole. So first, we're just going to take a look at the Q4 results from 2020 and some of the full year results as well, just from this earnings release from the beginning of February. So if we look at their revenues for the quarter of Q4, net revenues declined 5% to 8.6 billion, and organic revenues non-GAAP declined 3%. So they say this was driven by a 3% decline in price per mix, while concentrate sales were even, and it says the quarter included 2 additional days, which resulted in an approximate 2-point benefit to revenue growth. They say they continued to see improvement in trends compared to prior quarters, and for the year, net revenues declined 11% and non-GAAP organic revenues declined 9%. So this says driven by a 7% decline in concentrate sales and a 2% decline in price per mix. So obviously not great to see, but if you think about it, a lot of their business is based around people going out to events where they are going to have their drinks, so it definitely makes sense that their revenues are on the decline this year, but hopefully we'll see some strong growth in the coming 2021. And then if we look at operating margin for the quarter, the operating margin was 27.2% versus 23.9% in the prior year, while comparable operating margin was 27.3% versus 24.8% in the prior year. So actually larger or a little bit higher operating margin there. And then for the full year, they said operating margin was 27.3% versus 27.1% last year, and then comparable operating margin was 29.6% versus 27.9% in the prior year. And they say for both the quarter and the full year, operating margin expansion was primarily driven by effective cost management, partially offset by top line pressure and currency headwinds. So that's one of the things I've been noticing in a lot of earnings releases from Q4 and all of 2020, is basically they were able to cut some costs. They had to cut some costs and become a little bit more efficient and agile because of COVID, and hopefully they can carry that forward and continue, growing that operating margin, and obviously we want to see those revenues grow a lot next year. And then if we look at EPS for the quarter, EPS declined actually 29%. But comparable EPS, which is non-GAAP, grew about 6%. So it's just a matter of accounting principles. And the full year EPS declined 13%, while comparable non-GAAP EPS declined 8%. So definitely a decline on the full year, and it's obviously not something we want to see. But like we said, hopefully we will see some strong growth next year, or this current year, I guess. And that's what I'm really excited about, because it's expected, that the numbers aren't going to be great this year. For the quarter, the company's value share in total non-alcoholic ready-to-drink beverages was even, while for the full year, the company lost some value share, which is not good to see, them losing market share. And then they say for both the quarter and the full year, the company gained underlying share in both at-home and away-from-home channels, which was offset by negative channel mix due to continued pressure in away-from-home channels, where the company has a strong share position. So that's just looking at their market share in the non-alcoholic ready-to-drink beverage market. So you obviously don't want to see them losing market share. It's understandable if their revenues go down, but if everyone in the business, if all of their revenues go down, then it's not that big of a deal, right? But if they're losing out on some of the market, that's not good to see. So that's a little bit concerning, but it really wasn't a whole lot of loss that they saw there. So then moving on to cash flow, cash from operations was 9.8 billion for the year, which was down 6%, which was largely driven by pressure on the business due to the pandemic and currency headwind. And then full year free cash flow, was 8.7 billion, which is up 3%, primarily driven by lower capex expenditures versus the prior year. So obviously, like I said earlier, lower expenditures, better free cash flow. So there's a lot of other good info in that earnings release, but I wanted to just move on to the balance sheet. So I like to take a look at this, just some basic things here. So first off, just taking a look at the current assets, sitting right around 19.2 billion, which is a little bit lower from the end of the year last year, which is around 20.4 billion. And then comparing that to the current liabilities of 14.6 billion, that gives them a current ratio of definitely over 1. So that's something you like to see. That's something pretty vital in my opinion. And then obviously total assets are about 87 billion with total liabilities about it's 14 billion plus around 50 more billion, so around 64 billion for the total liabilities. So obviously it's good that the total assets are greater than the total liabilities. That's just some basic stuff, And then long-term debt is around 40 billion. So you can see that's a significant increase from last year. So that's obviously not something you want to see, but again, it's probably because of the pandemic. They had to take on some debt for some various things. And I have to say, one of the things I actually really like is that the company investor relations page is just super nicely laid out, in my opinion. So they have the balance sheets and the income statement and the cash flow statements just all laid out here super nicely on the website. You don't have to go digging through some earnings reports or 10Ks or anything like that. They're just laid out really nicely, which I appreciate. That's just obviously something small here, but I think that's nice. And then you just click on financial results. They have everything just listed out. So you want to go for the fiscal year 2020, you can look at the earnings release, the 10K, the presentation from the earnings presentation or whatever, and the transcript or the audio if you want to listen to the questions and all that kind of stuff. So it's just laid out super nicely here, and just from looking at other companies' investor relations page, I think it's a lot better, and that's something I do appreciate. And then also just taking a look at the dividends here, you can see their current yield is around 3.31% with an annual dividend of $1.68, and they're actually coming up here to pay on April 1st, so I'm excited for that. Seeking Alpha lists their payout ratio around 78%, which I think in reality it's currently a little bit higher, which is definitely not good to see. And one of the great things though is they are a dividend king with 58 years of consecutive dividend increases. So that's a great plus there. The 5-year dividend growth rate is a little bit low, only 4.25%. So that's not the absolute best, but it's definitely better than no raise at all. So I would say Coke is pretty solid dividend-wise, but it's definitely not going to be, some huge dividend grower like Microsoft or anything. But at the same time, you are looking at a fairly nice yield. So it's all about trade-offs, And just looking at the stock here, you can see there's still really have not recovered to the full level since before the pandemic, which a lot of companies have. And just taking a quick comparison to Pepsi, because obviously Pepsi is the company that Coke is compared to the most, you can see Pepsi recovered fairly nicely right after the big drop last year. And then they've had a recent sell-off a little bit recently, but you can see from basically the peak last year to currently, Pepsi is down around a little under 8%, while Coke is down around, I think it's near like 15% here. Yeah, 15.5%. So Coke is definitely a little bit lower, and they haven't recovered as much, but at the same time, maybe that doesn't matter as much because Coke's PE is a lot higher at 28 compared to Pepsi's at 26. So maybe that just means Coke was overvalued to begin with before the pandemic. But we're going to try to look at the PE ratios of the sector a little bit. So obviously Coke and Pepsi are both in this non-alcoholic beverages industry. I always say the wrong thing. They're in the consumer staples sector, and then they're in the non-alcoholic beverages industry within that sector. So you can see the average PE ratio for the consumer staples sector is around 27, and then for the industry that they're in, it's around 30.6. So Coke is right in the middle of those two numbers, but it's definitely not at a great valuation right now, I think. And then one of the other ways you can look at it is compared to the average PE ratio over a period of time. So this graph right here is the average PE ratio basically since at the beginning of 2006 or at the end of 2006. So you can see back here the PE ratio was around 14, 15, 16, 12. Then during the crash after 2009, it was around 9. And then 14, 15, 16, 20, 18, 20, 21, 26. And they had this weird spike at the end of 2017. I'm not really sure what that was, but it's kind of making the graph look weird. But after that, they were around 29, 29, 28. So even before the pandemic and this March crash last year, they were definitely at around the same valuation. So I would say Coke is probably not at the best valuation right now, and I think right now is probably not the best time to buy, but at the same time, they do have a solid dividend, and you're probably not going to go wrong buying them at this time, but definitely do your own research and try to figure that out for yourself. And then just looking at my position right here, you can see I have about 1.23 shares, and this is about $62 that this position is currently worth, and that's about 4.95% of my account. And over the next year, they'll pay me a dividend of about $2.07 if I do not add to my position at all. So that is a pretty solid dividend, around 3.3% yield, like I said before. So like I mentioned before, I don't think Coke is at the best valuation right now, but I would encourage you guys to do some research and try to maybe figure that out for yourself, or come up with some idea for yourself rather than just listening to me, because obviously who knows if I am credible, so I think my information is fairly good, but maybe you don't think that way, and so you need to figure that out for yourself. So for me, I don't think I'm going to be adding to my Coke position too much anytime soon. Maybe if we see a little bit more of a correction, then I will, but right now I'm pretty content with where it's at. I'm content with that solid dividend that isn't really going to go anywhere. And when comparing it to Pepsi, I think Pepsi is probably a slightly better company. They have a lot more than beverages. Most of Coke's business is focused on beverages, while Pepsi has a lot more snack foods and things of that nature. So that's a good thing about Pepsi. And then also some of their dividend metrics with Pepsi are just a little bit better than Coke's in the recent years. So those are all things to consider. But at this time, I'm not going to be adding Pepsi to my portfolio. I just kind of wanted to build my current positions up in my portfolio before I add any new companies. But there are definitely a few new companies I would like to add in the future. But for now, I'm just staying put. So if you guys did enjoy this video, remember, like I said, to give it a like. I'll leave some other videos right up here, up here, that you guys can check out of mine if you want to. And I will see you guys in the next one.